Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
We're back. Whew. Didn't think I was going to make it in today. Yeah, hey, great to see the snow out there. And like the man said, this is Bill Bullington here every Saturday morning from 11 to noon on 1420. And also simulcast, not simulcast, it's a delayed cast on 1220 Saturday or Sunday nights at 6 o'clock, 1220 our sister station. And you can pick this up on iTunes, Bullington Capital Report, if you'd like to get it as a podcast. You can also go to 955thefish.com. They carry it there. And actually, that's probably an easier place to get it from. That's 955thefish.com. So with that, and if you have any questions today, you can feel free to give us a call, 216-901-0945, 216-901-0945. Got a lot of interesting stuff to talk about as soon as I get set up here. So apologize, I was running a little bit late today, and it'll take me a minute to get all set up here. But again, I'll just preview by telling you that we've got a seminar. I'll remind you of that. We've got a seminar coming up January 18th, and I think it's pretty interesting. There's a lot of stuff going on, a lot of stuff to talk about. The tax breaks, what impacts that might have on the economy. I was just talking to my accountant, and we're talking about how things are going to work for a lot of small business owners. What are the impacts long run on the taxes? By the way, what they're doing should be reasonably beneficial for some stocks, not all stocks. But the bottom line is we're in an expansionary phase in the economy. It's finally picking up, getting back to the normal long-term average growth rate. We've been below average for so long. I think people have kind of gotten accustomed to it, thinking that that was the average. And it's actually, typically the country grows at a rate that was 50 to 60% higher than the rate that we had seen for 8-9 years in a row. And I get it. When something happens that long, you think that that's going to be the normal. So this should be beneficial to stocks of all different sizes in different ways. Different industries are going to benefit differently, for lack of a better word, or concept. But we're going to explore that, and I'm going to try to get one of the accountants that I work with from Apple Growth Partners right here in Northeast Ohio to come in and talk about it more specifically sometime in the near future. And because, I think some people are going to benefit, some people not so much. But overall, it'll probably have a relatively positive impact on financial markets, at least over the next couple of years. And, you always hear a lot of stuff on the internet. I see a lot of stuff. People send me stuff all the time. And I'll tell you, some of the stuff is actually pretty good. Some of the other stuff, I'm going, wow, where did they get that? Where are they getting their information? That is not accurate at all. But anyway, so you have to be careful. You've got to be really careful what you're reading, the websites that you're paying attention to, because the vast majority of them have some sort of bias or opinions. Some of them are out there just expressing their own views. And really, oftentimes, there's a bias. I'm not even sure that some people are aware that they have a bias, which I can think is kind of funny. But anyway, the reality is financially, things that are going on probably going to be relatively beneficial for stocks. That's a good thing. Bond prices probably going up a little bit. Interest rates going up a little bit. That drives bond prices down. But I don't think it's going to be major. I think it's going to be a gradual shift. I listen to and read what a lot of the top economists at some of the top financial management firms in the country are saying. And yeah, its comments makes perfect sense. They probably see a long-term or short-term rates peak out somewhere around 3% or so, which is still not bad. And a lot of people would love that. Get 3% on your short-term money. It'd be nice to see a 3% CD. I can't believe I'm saying that. When I started in the business, CDs were a lot higher than 3%. I can tell you that. But anyway, it's one of the reasons that bonds have done so well over the years. And feel free, as always, to email me questions, bill@bullingtoncapital.com. Go to my website if you want to sign up for that. The next seminar, it's 2018 Risks and Rewards. The changes outside of the tax legislation. Tax legislation, by the way, doesn't have huge impacts on stock markets. It'll have an impact, but they're generally not that large. In fact, we used to have a tax system in this country where there was a 90+% bracket. There was a tax bracket that was over 90%. Now think about that. If taxes were over 90%, well, then what would happen? Consumption would drop significantly. I can tell you that for sure. But so we've gone through that in this country, and yet the long-term average for stocks is still the highest of any of the asset classes. So that's one of the things you probably want to keep in mind. And I used to read a lot. I used to keep actually a couple of Peter Lynch's books around. Peter Lynch, for those of you that don't know, because I know a lot of you are younger and probably have never heard that name, he was a portfolio manager that had done better than any mutual fund managers ever done. Nobody's ever matched his track record for the time that he ran the Magellan Fund for the Fidelity organization. And he wrote a couple books, very helpful, I thought. But only if you like that sort of thing. If you didn't like that sort of thing, it was very helpful as a sleeping aid. And actually, I'm kidding. His books were very well written. Even if you didn't like that sort of thing, I think they were pretty well written. Anyway, he talked about economics and how it related to the stock market. And I think his words were somewhere along the lines of, he didn't spend more than 10 minutes a year reading economic reports. And everybody is always, a lot of people, I shouldn't say everybody, a lot of people are shocked by that. What? You've got to read it. No, actually, he was, one of the reasons he was such a successful portfolio manager is that he knew that stocks don't make sense in the short run. And looking at GDP, looking at M1, M2, if you know what those are, they're different measures of how fast the money supply is growing. He said it was basically, they were so useless that he didn't bother looking at it. And I thought that, that's actually a great idea. In fact, most of the people that have had really good long-term track records don't look at that. The other thing they don't look at is short-term performance. That's one of the things that the long-term people that are successful over decades, they don't look at a 3 or 4 year time period and try to make a decision based on that. And I can tell you that is probably the number one item the average investor looks at. And in fact, most of them don't even know that they're doing that. They look at a 3 or 4 year track record. In many cases, it's a 1 or 2 year track record, because if you have a really good year, your 3 and 5 year numbers go way up because of that last year that you added there. It has a significant impact on its 3 and 5 year averages. So that's not a good thing to hang your hat on if that's all you're doing. You've got to look at how that track record was accumulated. What kind of stocks were they investing in? You have to look at the top holdings now and kind of get an idea or feel for what the portfolio managers are doing. So, and that's not easy. That takes real effort. It's easy to look up past performance and expense ratios. That's easy. Okay? And if investing were easy, there wouldn't be an occupation. Everybody would just put their money in the same funds, get the same returns. There would be no chance to do better or worse, which actually might not be a bad thing. But anyway, that's not really how the world works. In fact, the investment world's constantly changing. And one of the things we're going to talk about at the seminars is how it's been changing over the past 4 to 5 years. Now, what's really interesting about this change has been going on for the past, probably 14 or 15 years. It's accelerated. The past 5 years, really past 10 years, there have been more new funds coming out than there have been new stocks for them to invest in. Okay, and that's created a very specific set of complications which can lead to advantages if you're aware of it and disadvantages if you're not. So that's what the seminar is going to be about. We're going to take a look at that. What kind of impact has that had? And I've got some really good visuals, excellent visuals, to show you why I think the things that are happening right now are happening. And because that's another thing about financial markets. Like, I thought economics was bad. That's what I majored in college. And they used to say economics was the dismal science. Yeah, because it was very, very difficult to make a forecast that actually came true. Never mind that nobody's ever successfully been able to do that very often. Typically no more than one time in a row, especially a major turning point. But people still try. They still try to do that. And investing is very, very similar. What you think should happen typically doesn't happen, at least not in a time period that you think it's going to. And that's the hard part. In the time period that you think it's going to. You're going to be an investor in today's markets. You got to be prepared. And there's something you really need to be doing right now. That's getting a true level of diversification, because we have diversification, but it's not extremely well diversified. If you look at the S&P 500, which has beaten just about everything on that planet over the past 5 years, that's happened before. It'll happen again someday. But when you look at how it's beaten it and you go, wow, that looks an awful lot like the late 90s. It looks an awful lot like the late 90s. Now, those of you that are too young to remember the late 90s or didn't have any money to invest, you're going to get to learn that lesson the hard way. And I've had a lot of people over the past few months, few years actually, or not few years, the last few months, that are like they're throwing the towel in on their strategies. And probably the time that they, that's about the time that they actually start to come back and start to work and bring you back out in front again. And yes, it's frustrating. If it weren't frustrating, I wouldn't have a job. And you never really know if it'll ever come back. That's the thing. You look at the difference between small company stocks, look at the Russell 2000 and the Russell 1000 large company stocks. Okay, over long time periods, the large company stocks will beat the small stocks over very long time periods. Sometimes 3 or 4 years in a row. That's a very long time period for the average investor. That's not a very long time period for a professional, by the way. That's one of the differences between a professional and a non-professional. Non-professional thinks 3 or 4 years is an eternity. Professional looks at it as a very small moment in time. So, and I know that's not what people want to hear. They want to hear that you can predict the market out 1 or 2 years. Well, that's why the average investor ends up suffering. Or if the average investor ends up underperforming for 3 or 4 years in a row, they move. They're gone. The above average investor says, am I doing what I should be doing? Am I doing the right things? If I'm doing the right things, eventually that works out. Again, going back to the Russell 1000, the big companies, and Russell 2000, the small companies. For years, sometimes the big companies will beat the small companies. Years. And then all of a sudden, those small companies come ripping back. In fact, that was not, if you take about 13, 14 months ago, that was the exact situation. The small caps they were getting smoked by the larger companies. And people just automatically, I understand what happens, but they automatically project that into the future like it's never going to change. Like the large companies are always going to beat the small companies or the international companies or the emerging market countries. Yeah. That's always going to happen. Why? Because it's been happening for so long. See, 3 or 4 years for them is an eternity. They don't understand that's not how financial markets work. In fact, the worst performer of the past prior 5 years is the best performer this year. Surprise! Yeah, that's exactly what we're talking about. Exactly what we're talking about. So you have to have a lot of patience to be an above average investor. An average investor gets tired if they underperform 3 years in a row. God help you if you underperform 4 years in a row. They're gone. They'll skip out, and then sure enough, as soon as the last one leaves, if the last one gives up, that turns around and starts working again. It's just the way it is. I feel bad for everybody. And it's even though you know it's happening and you've been there before and you've studied this throughout history, it's still hard. It's still hard to put up with. Anyway, I'm going to take a phone call right now. And I've got by the way, if you want to call in, 216-901-0945. And who am I speaking with?
Hey, Bill, this is Michael Perchak, your favorite artist.
Oh, hey, Mike, how you doing?
I'm just fine. I just thought I would call in and wish you a Merry Christmas and a Happy New Year and tell everybody that they should buy art off me for 2018.
Yeah, that's a good idea. The Michael Perchak, by the way, is an artist, and I met him. I think we were hanging out at a Starbucks. And yep. And what's your website so people can go and kind of get a look at the art?
It's tsmfinearts.com, and that basically is. It's just that one's just like portraits, headshots, and that sort of stuff. It doesn't have a lot of stuff I do, like the comic book art, like the Daredevil you bought off me, or anything like that. But that's a good start for people if they are curious, or they can just wander into the independent Starbucks this morning. I'm there.
Yeah. So Mike's an artist, and he does most of his work in pencil.
Yeah.
Yeah, because that's the one that I bought is the Daredevil. Daredevil was one of my favorite Marvel characters. And that's why I bought it, mainly because I just liked Daredevil, and he does a phenomenal job. So I've got an original drawing of Daredevil, and it's at home in a frame. I look at it all the time. But you also do portraits and stuff for families, babies, weddings.
Yeah,
I'm sure.
About everything: families, weddings, babies, anniversaries, even a sprinkling of nudes. As a matter of fact, there's a gallery in Bedford that put up a couple of nudes of mine, and I was really surprised because I said,
"Well, hey, Mike,
I think I could sell these."
Yeah, we're gonna have to take a commercial break, but give us that website again.
tsmfinearts.com.
All right. Well, hey, have a Merry Christmas, and thanks for calling.
Oh, you too. Thank you.
Sure. Bye-bye. It's Bill Bullington. I'll be right back after these commercial messages.
You know Dasher and Dancer and Prancer and Vixen, Comet and Cupid and Donner and Blitzen. But do you recall the most famous reindeer of all? Rudolph the red-nosed reindeer.
And it was the night before Christmas. And all through the house, everyone was in a panic, even the mouse. I'm not sure what his problem was, but that's beside the point. There were frantic, bustling people making cookies, pies, and cakes when little Johnny accidentally tore down the outdoor lights with one swipe of a rake. When we arrived home from the hospital after they treated little Johnny's burns, his brother little Tommy fell down through the chimney and busted his knee, back to the hospital at 2:45. By the time we got home, it was the day before Christmas, and things began to settle down. Mom drove into town to get some last-minute Christmassy things, and when she got home, everyone had gone to bed. So she finished her work, and then it was the night before Christmas, and all through the house, not a creature was stirring. And, well, I think you know the rest of that story. Oh, I know that was bad, but, oh well. I was going to send that to Will Ferrell. Anyway, if you'd like to call us today, 216-901-0945. I hope everybody does have a really happy and safe holiday here. It's one of my favorite times of the year. I'm sure I'm not alone in that sentiment, but feel free to drop us emails, Christmassy emails, and if not, that's okay. By the way, you can also send us questions at actually go to my website, bullingtoncapital.com, and there is a form on there, and you can submit questions. Feel free to do that. A little later in today's show, I'm going to talk about some of the stocks that we're talking about. It's I think it's a really good thing. One second. Okay, I just got a couple of emails. That's funny. Got a radio show question. Is there any way to short the Bitcoin craziness? Actually, they're working on, I don't know if you know what Bitcoin is or not, but it's called a digital currency. You can basically buy these things called Bitcoin that some private businesses put up online. So you're buying Bitcoin, which is a currency like the dollar, but it's not backed. The dollar is backed by the United States government and the Treasury. Bitcoin isn't backed by anybody. It was created so that people could trade it back and forth. They could trade their dollars for Bitcoins. And now one Bitcoin is very expensive. It's been going up and down. And the person asked if there was a way to short it. Short it means selling something that you don't own. So you're short. You're selling something that you don't own. That's what short means. So if you thought Bitcoin was going to go down, you would try to sell it at its current price. And if it dropped, you would buy it back at the lower price and you would make a profit. Well, there hasn't been a way of doing that yet. And I'm not sure if the exchanges that they were going to make futures contracts on Bitcoin. So that would be one way to bet that it was going to drop, or to sell it short. You would actually go sell a futures contract instead of actually selling the Bitcoin. And one of the reasons Bitcoin, by the way, has been going up so high, it's really caught the imagination of the individual investors, and you've gotten some institutions involved, and there hasn't been a way of selling it short, which would probably increase the volatility quite a bit, and it would go up and down more frequently and probably a little faster. It's kind of like gold. Nobody really actually, well, some people do buy the actual metal. You can buy the metal and hang on to it. Then you're responsible for the storage, and when you go to try to sell it, you've got to find somebody to buy it, and they're probably going to charge you something for that as well. So people buy and sell gold futures contracts too. That's what they're working on with Bitcoin, a way to be able to do both transactions, to sell short and buy. So I don't know if that's finished yet. Once they get it done, then other people will do it. But I'll say this. It's very volatile. There's no doubt. You look at the chart on Bitcoin, it's got to be volatile. It's extremely aggressive. That doesn't mean that you can't do it. I'm going to probably put $1,000 in it and just let it go. I figure what I'm doing is I'm going to be kissing that money goodbye, but maybe it'll go higher. And I guess the reason I think that maybe it'll go higher, I was reading something about Bitcoin, and the total value of all the Bitcoins that have been mined is somewhere around 0.1% of the money that's invested in financial markets. So I'm thinking 0.1%, and it's this high? Okay, what happens if it goes to 2 or 3%? Now you're talking about, that's a double or triple. What if, and that's probably a pretty large and lofty number, but I wouldn't count on it. I wouldn't put a lot of money in this. In fact, what most people should be doing, and we started to talk a little bit about this, and we're going to be talking about this at the seminar on January 18th. What should you be doing with most of your money? With most of your money, you really want to try to get spread out in all asset classes. And I used to, even 15 years ago, that was impossible. To do the things that you were being told to do by the big financial firms who were supposed to know, what to do, you couldn't do as an individual investor. You couldn't get the types of investments that they were talking about. They didn't exist. So that's what the explosion of exchange-traded funds has done. It's actually put a lot of institutional tools in the hands of individual investors. So the trick is, which ones do you buy? How do you buy them? What are your goals for long-term and short-term? How do stocks that pay dividends differ from stocks that don't pay dividends? Why is that important to somebody who's retiring? And that's a big deal, I can tell you right now. Those are the kinds of things we'll be talking about at the workshop. Why, and you may know, but you'll probably be guessing. But I'm going to tell you, I'll show you at the workshop. Why are we going to be doing what I'm suggesting that we're going to be doing? Why is the portfolio that you're invested in the stocks that it's in? What kind of characteristics do those stocks typically have in common? You know, these are all things that you probably should be thinking about if you're out there looking at portfolios. The vast majority, and I'm telling you, the vast majority of people are going to look at what just went up the most. And I see this all the time. It's probably it's very common that somebody has invested heavily in their own company stock. And I know they're probably, I've had this conversation at least 3 times in the last 2 weeks. And all 3 of the people that I've had this conversation with probably think I'm talking about them. But you're not. And you're not, I hate to break it to you, but it's not like super unique. When somebody's worked for a long time for a company, has done very well in that company's stock, they have an affinity, they have an affection for it. They love that company. Now, talk to anybody that worked for GE in the late 70s, early 80s, and all the way up through the early 90s in Northeast Ohio. Those guys, you know, they made an unbelievable amount of money. Look at, and there are other companies out, lots of companies around there. Ford had a run in the 1980s. It was just phenomenal. And since then, it's had multiple periods where it's really suffered. I mean, a lot. So, and that's probably one of the hardest things, I think, for individual investors to kind of come to grips with, is that, yeah, you might not make any money. In fact, Ford, if I look at it's trading at the same price now it traded for in 1994. And you're talking about 2004 is 10 years, 2014 is 20 years. It's selling for a little bit less than what it sold it for 20 years ago, than what it sold for. And by the way, you'd have seen it if you had purchased a lot of the shares in 1998, it was selling at a price that's more than twice what it's selling for today. Actually, let me pull it up. Yeah, a lot more than twice. Shoot, it's like 250% higher than it is today. And that's in 1999. So that is I hate seeing that. Somebody that bought a lot of the stock and did incredibly well. You bought stock in 1984 and you adjust Ford for all the splits that it's had over the year, you're paying a little over $2. Okay, you're paying a little over $2 for it. By 1987, that would have been $10. You'd be up. So if you had $200,000 in there, you'd have $1 million. $1 million. And then you go a few years later, it's down to 450,000 from $1 million down to 450,000. And then you go from that price all the way up to $35. When you go from $2 to $35, that's amazing. You can't tell anybody that anything ever bad is going to happen. They just don't believe it. And then, of course, in 2009, you go from $35 all the way down to $1. So it's back to where it was. It's actually half of where it was when you started out in 1984. Think about that for a second. So that's what's really difficult when somebody's worked a long time for a company that's done very well, and to tell them that, hey, look, it's still a stock, that I wouldn't count on that going into the future. They have a tendency not to believe you. And if you talk to people about GE, and I know everybody that's ever had this happen to them is shaking their heads and going, yeah, I know, I've seen that. Yeah, and I'm really sorry about that. I really am. That's one of the reasons is you've got to diversify. The S&P 500, for example. The S&P 500, 500 companies, 500 of the largest companies in the world, headquartered in the United States, most of them. The vast majority of them have most of their business in the United States. A lot of them get about half their revenues, by the way, from overseas countries. But anyway, when you look at how that index is constructed, it'll do very well in a rising market, does very well, actually outperforms most other indexes. In a down market, it goes down a lot, mainly because of the way that it's structured. Right now, 50% of the holdings are in the top 50 stocks. Remember how many, see the word, or the title, S&P 500? The 500 refers to 500 stocks being in the index. When half the money's in the top 50, that means 450 stocks get the other half. You're splitting that up. So you're not as diversified. That is not a good level of diversification. And it creates problems because when it's doing well, people keep pouring money into it, and it'll keep doing well until it doesn't, like it did back in the late 90s, and then it went through a 50% drop. And nobody, by the way, was able to predict the exact time that was going to happen. In fact, one of the greatest investment strategists of all time, the guy's he's passed away since then, predicted within 3 months. He was the guy that got it the close. Actually, I take it back. Was within 6 months. He's the guy that got it the closest. His name was Barton Biggs. Was head of one of the super large companies. Now that I mentioned his name, I don't want to mention their name because they put him out to pasture. Basically, they didn't fire him. They just said, "Hey, you know what? You're raining on our parade. Be quiet. Go away. Sit over there. Just ride out the rest of your career." He was upset, and I'd have been too. And he was within 6 months of the actual peak. And a lot of people go, 6 months, and that's not that. You can't. That is unbelievably uncanny, quite frankly. So if you really knew a lot about this, you would go, "Wow, that was pretty impressive." That he was within 6 months, because that whole thing lasted 5 years. 5 years, the S&P was tearing everything up. And then it'll do that until it doesn't. It's like every large company stock in the world, at some point in time, they're all stocks. Stocks are kind of like people. They go through phases. Sometimes the difference between a stock and people are that occasionally a company who has publicly traded stock will go through a transformation and enter a new growth phase. Wouldn't that be great if people could do that? That'd be awesome. Yeah, man. Think about that for a second. They're working on that, by the way, and hopefully it'll happen before I die so I can go back to being young again. Although I'm not really sure I want to do that. If I don't get to take the experience with me, I'm not interested. So, but anyway, you've got, I just lost my whole train of thought there. That is hilarious. By the way, you can call us today, 216-901-0945. When we come back from this next commercial break, I'm going to talk about some of the stocks that I see moving right now. We're going to be talking about this at the workshop. Markets have changed. There was a tool that was just added within the last, probably the last 7 or 8 months to one of the tools that I use. And I'd always known the basics of trend following, which I think is a great way to invest some of your money. Not all of it, but some of it. We're going to be talking about that. It's gotten a lot easier today. It's actually a little more effective than it has been in the past, believe it or not. So we'll talk about that when we come back from these commercial messages. This is Bill Bullington right here on 1420 The Answer. Stay tuned.
The Christmas tree at the Christmas party hop.
Deck the halls with boughs of holly, fa la 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 la. 'Tis the season to be jolly, fa la 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 la.
And we're back. Hey, Friday was a short day. Well, actually not a short day. It's just a relatively low volume day, being that we were going into a vacation. That tends to happen a lot in exchanges. But there have been some things that have been going on. There were a handful of stocks that still came up on the scans that I run. And something I find incredibly interesting. I don't know if any of you know anything about this, But a lot of the coal stocks have been showing up on scans, and a lot of them have really nice looking charts. In fact, a couple of these companies have just come public. And what's interesting to me is that they look like very classic breakout patterns, and that's something we're going to be talking about at that seminar on the 18th. What is the pattern that shows up right while a company is making a big move? You'll see this pattern repeat itself, by the way, all along a big move. It happens multiple times, generally. So I'm going to show you what that pattern is at the workshop, by the way. So this pattern has been showing up in stocks that are related to coal. And coal's been nothing but bashed for the past few years. In fact, a lot of these stocks are way below where they were a few years ago. And so why are they running now? Why are those coal stocks running now? And they've got to be multiple reasons, I'm sure of it. I just keep seeing them coming up, and I think that's interesting. Some other stocks that have been doing very well. It'd be interesting to see what that's like. The retail, particularly the clothing retail. And I think I'm pretty sure why that's happening. Clothing is something that, when you buy, you take back. You'd like to try those things on in stores. And you like to have someone, it's tough to send that back to Amazon. People do, and they've got these drop-off facilities now. They're trying to accommodate that. But realistically, clothing is not like buying a book or buying an appliance, a small appliance, or a radio, or the kinds of stuff, whatever it is, the millions of products that Amazon sells. Clothing you kind of have to try on. Not always, and a lot of people don't. I'm sure that'll probably change over the years. But anyway, it was one of those things that I thought most people like to try it on before they actually, and they like to be able to take it back and get something, that day. It's just a convenience thing. So I've seen a lot of those companies come up on scans. Don't know if they'll keep going higher. I know that their valuations are low, the vast majority of them, and that's a good thing. So when you get a company that may be undervalued and its share price is moving up, that's what we're looking for. Those are the types of things that you want to look at, particularly if you are following trends. Now, if you're following trends that are going through the markets right now, those are two. Retail's been doing very well. These companies that are involved in the coal industry, it's crazy. And you know what? What will probably happen, which typically happens with stocks, is that somewhere down the line, let's assume that this is successful and that industry just keeps marching higher over the next few months. If that were to happen, the news that comes out, 6 to 9 months from now, typically, will explain why the move happened after it's already happened, which is why one of the reasons you want to take a look at price movement. You kind of want to look at patterns. By the way, Peter Lynch talked about looking at charts. He was not a technical analyst, and he didn't like technical analysis, by the way, is looking at price movement for patterns. Some people really believe heavily in it. I just think it's a tool. I don't think that you want to use that as your sole guide, but that's me. That's my personality. I like to use it as a tool because there are patterns that show up. You can see them. I can point them out to you. Actually, I've written a little bit of code that you can use with this software program to show you those stocks that are experiencing and exhibiting those characteristics right now. And it's pretty common sense, actually. When somebody explains it to you and you see it, you're like, oh, wow, why didn't I know that before? Well, believe me, after sitting down and looking at thousands of stock charts over the years, it's going to pop out. It'll happen. You'll see it. Now, if somebody points it out, if somebody had been able to sit down with me and say, hey, Bill, check this out, I would be way ahead of where I am today. And I want to be very clear on this. This is not a get-rich-quick scheme. It is not. This is not something that you should do with a large percentage of your money. It's not. 10 to 15% is actually pretty good. And I think you should treat it more like a hobby than you do, this is how I'm going to make all my money. That's way too much stress for anybody. I don't even do that. I do this every day. I'm up really early doing this every day. I'm looking at it at night before I go to bed. Now, it's not because I'm a workaholic. It's because I like it. It's because I really like it. So if you really like it, or you think you might like it, you might want to get to that seminar. It's January 18th. There's no cost to attend. Seating is limited. I think we're going to have a lot of fun. We'll also talk about what you should be doing with the vast majority of your money. What's changed in financial markets that's created opportunities. By the way, it affects both the trend following thing and your regular investing. And there's some things I feel strongly you should be doing right now. You should be looking at trying to do. Some of the things that hadn't been working quite as well over the past 2 to 3 years have started to work a lot better now. I'm apologize for those of you people that gave up on it already. You missed the last few months. It's been pretty good. But that's the way it goes. And that's why investing is a really difficult thing at first. It takes a long time to get your arms around how this stuff actually works. And again, I'll skip that part. But if you're looking at things realistically, if you're looking at how markets move over time, I've got a couple charts that we're working on. I'm going to bring up. Hopefully that'll help us explain some of what I'm talking about, because it's really hard to do when you're on the radio. If you just put something like that out there with no visual, that's incredibly difficult to do. But I think you'll really like what you're going to see. I think it's something that you can take with you. Some of you will actually, it's going to accelerate your learning curve. What do I mean by that? Well, learning curve, that used to be a word around. I'm showing my age there. It'll reduce the amount of time it takes for you to learn about investments and investing. Let me put it that way. It'll reduce the amount of time. I'm going to explain some of the more complicated concepts, hopefully in relatively simple terms that everybody can understand. Now, having said that, everybody's a little bit different. And if you come from a different part of the country and you speak English slightly differently, maybe it doesn't work for you right away. That's actually in this part of the country. I find myself thinking differently than a lot of people do, and it gets pretty difficult to communicate. But I'll keep trying, and it is relatively simple to do. But anyway, if you've got phone calls, questions, or comments, please feel free to give us a buzz. The 216-901-0945. I know on this the day before Christmas, you're probably pretty busy out there running around and trying to get that last minute Christmas shopping in before it's too late. In fact, I'm guilty of doing that myself. I will be stopping by the mall on my way home. But I don't have to do all of it. I will say that. And fortunately, the stuff I have to do is relatively easy. So having said that, let me go through what I've been seeing in financial markets. Okay, this is very interesting to me. A lot of trucking companies, a lot of logistics companies involved in shipping stuff around the country have been showing up on scans, and they've been doing very well. A lot of these stocks are up a lot in the last few months. Many of their valuations are still very low. So that is it's fascinating to me that they're actually doing as well as they are. And I'm not sure why. I'm sure that there's an anticipation that the economy is accelerating, that's for sure. So the economy accelerates, consumption goes up, GDP is up over 3% for the first time in 8 or 9 years. So that means the shipping companies are doing pretty well. They're showing up on scans. Now, I will tell you, I have kind of a bias against that sort of thing. But here's mainly because they're not like a technology stock who can come out with a new product that sells like crazy and then their sales double or triple over the next 2 or 3 years. That's one of the reasons I like technology stocks, because that happens. Whether it's something to do with the internet or healthcare technology, that's another area where you can get really big movements because sales expand rapidly. With a transportation company, the sales are not going to expand. They're not going to grow 40 or 50% from one year to the next. That typically doesn't happen unless there's a merger. Okay, but organic growth is generally not all that intense. You get an 8 to 10% year, and everybody going, "You woohoo!" And profit margins do get really high when their sales go up by 8 or 10%. In many cases, they'll double or triple, even quadruple the profit margin on a relatively small sales increase with a transportation company. Lots of reasons for that. I won't bother getting into that today. If you want to know why, go to the workshop, sign up for it, or call me, send me an email. I'll be glad to answer it. So here's the, and by the way, here's a company. This is another coal company that just came public. Again, like I was saying, the coal company, Consolidated Energy. These guys just came public right around $24. It's at $35 now. It came public at looks like it opened trading around 25. Goes down under 20 in the first week or so, probably because I thought I was going to buy it. Then it goes up. It's at $35.98 now. The CEIX is the symbol, by the way. I wouldn't recommend purchasing it. But anyway, that's the wrap up. I didn't get to some of the other stocks. I'll cover that next week, next Saturday morning. But there are a couple other sectors there that look really good. Other than that, if you have any questions, email me, bill@bullingtoncapital.com. Go to my website, bullingtoncapital.com, to sign up for the workshop. Have a good week, everybody. Merry Christmas, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.